Global Multi-Asset Investing, 10 Charts to Watch in 2020. So some of you might have seen I put this article out a couple of days ago now, basically the top 10 charts to be across for some of the really key macro market issues coming up in 2020. A lot of these are already sort of in play. They've been in play for a few months now. But what I wanted to do with this YouTube post is to just do a quick run through of this blog and add a little bit of extra comments and commentary context to it, and hope you enjoy. Any questions, just pop them in the comment section of the YouTube video. I'll be replying and reading to them all, so let's get on with it. Number one, a global economy. So what I'm going to do is, for each of the 10 charts, I'm going to just describe what the actual chart is, how it's kind of made, and what the implications are. So this first one here, the red line is probably the starting point. So it's a monthly diffusion index of all the different countries that the OECD calculates the composite leading indicators for. Those OECD composite leading indicators, I've found that those tend to be more a measure of the cycle rather than a pure leading indicator as such. But funnily enough, when you look at this chart, that red line is actually acting like an actual leading indicator. I mean, to my mind, a leading indicator should be telling you something that's coming in the future. It should be providing a lead to whatever other thing that you're looking at. So the other thing that we're looking at in this is the black line there, which is they called it here the OECD plus 6 NME, which is the 6 non-member economies, which is, you probably can guess them, China, Russia, etc. Basically, that black line is the global cycle indicator. We'll call it the cycle indicator rather than the leading indicator. So that one has already sort of started to show signs of turning. But the key point of this chart is that red line is hooking up, basically implying that we have already seen the worst of the global recession. I mean, at this point, you kind of have to already call it a recession. I mean, it's not a recession in the same sense of, the one in 2001 to 2002, that sort of period there, or the, obviously there's nothing like the global financial crisis, which, that shouldn't really be your yardstick for measuring what a typical crisis or, recession should look like. That's kind of, well, tempt fate and call it a once in a lifetime event. But anyway, certainly if you look at industrial production or exports, it's definitely the global economy in those particular sectors has been through a recession, and now we're seeing an end to that. And my base case is that we see a significant and synchronized economic upturn for the global economy this year. A big part of that is monetary stimulus. We're seeing some fiscal. And actually, as a side note, I am going to go through sort of each of these charts over the next 10 weeks and do like a little bit of a focus post on each of them and just expand a little bit. So I'm going to expand a little bit more on that one in terms of, how this growth is actually going to come about. But, one thing that always makes it easier to boost your year-on-year growth figures is when you're coming out of a fairly low hurdle rate, which is basically where we're in now. But anyway, key message for chart number one is that we're already starting to see the cycle indicator turning, and the leading indicator of the cycle indicator has hooked up. So the base case there is global economic rebound. Number two, emerging markets. This is kind of a subset really of the first chart. So what we've got here again is the OECD leading economic indicators, but we've got a GDP weighted average for emerging economies there. in the black line. And as you can see there, they have already started to turn, and that blue line there is monetary conditions indicator for emerging markets. Tends to operate with about a 6 to 8 month lead against the cycle there. Emerging market central banks, and I don't think many have actually noticed this, the magnitude there, but a lot of the emerging market central banks have been quite busy and aggressively easing policy. If you look at the way that they've been doing that, they've got, the most sort of traditional policy ammunition. A lot of them are operating very far from the zero lower bound, and so they've as a result of that monetary stimulus there, I expect the economic rebound this year to be particularly pronounced in emerging market economies. I mean, that chart kind of speaks for itself there, and it's also why I would say, while I expect global quote unquote to be turning up, I think it's going to be led by emerging markets, which is kind of probably outside of what most people are thinking. But should these two come to pass, it's going to make for a fairly constructive backdrop, and that's going to be having pretty significant implications across asset classes. I do echo the implications of these two charts across the rest of them, so definitely keep these in mind. The other thing I was going to say is something that I've forgotten. We'll move on. So chart number 3 there is growth assets versus defensive assets. So this one is showing, well, let's explain the chart first. The defensive assets there, and we can kind of debate whether they are true defensive assets, but typically these ones perform better when things aren't going well. And that's bonds, REITs, and gold. And what you've got here is the standard deviation, well, Z-score rather, of historical Z-score average across those three assets, showing up as pretty extremely expensive, really. And then for the growth side, you've got valuation indicators for S&P 500, international equities, and commodities. And it's not as cheap as it was, but basically they're still on the cheap side. And really what that chart is telling you is that growth assets are still actually cheap and defensive assets pretty expensive. And when something's that expensive, it kind of changes the nature of the forward-looking risk return kind of landscape. So for defensive assets, being this expensive kind of puts them at risk. And again, it kind of brings into the question, are these actually going to be hedges of risk, or are they going to be sources of risk, as I've noted there? And that's, it's an interesting question to ask. In some ways, it's just touching on a truism of these kind of assets. I mean, bonds typically will not do well if the global economy is picking up, inflation's picking up anyway, but typically will do well if growth is rolling over, inflation's falling. It's that kind of life cycle of the business cycle, asset market cycle. I think, if push comes to shove, and, my earlier sort of assertions here about a global growth pickup, if that doesn't happen and then we go into a deeper recession and crisis, then obviously defensive assets are probably going to perform, maybe because valuations are so expensive they don't perform as much, they don't perform as well. But certainly on the growth side, if you get the scenario of EM leading global growth pickup, then growth assets are going to do well. Defensive assets are not going to do well, and possibly because valuations are so high for defensives, they do worse than usual. So that's definitely something to be contemplating. Number 4, tips, break-evens. So this is just the kind of inflation component of tips. So that's the inflation protected version of treasuries. And so this is kind of, you could think of this as a market-based version of inflation expectations. It, at least in recent history, it seems to have this sort of mean reverting tendency. So you can kind of view it as this chart as a valuation chart. In that sense, late last year, it became very cheap. And at that time, I was beginning to put this earlier case of global growth tick up into together, and so that made the bullish view here fairly straightforward. If you look at the way that break-evens trade, they tend to trade quite closely with emerging market equities, emerging market bonds in local currency terms, and things like copper and crude oil. I mean, trades very closely with crude oil for a couple of good reasons, but the point there is basically expecting this environment where sort of inflation expectations are going to pick up. And back to the start there, if we think about this view that global growth picks up, and as I mentioned there on the first chart, the global recession aspect, it really was concentrated in exports and manufacturing. The consumer has actually held up pretty well throughout this. And, in particular, job markets globally have been quite tight. And so if that remains constant and you get this upturn in the, export manufacturing sectors, I think inflation is definitely, upside risk to inflation is definitely going to be something that we have to think about. I think there's probably still some people that are focused on the deflation risk, and that'll come again. But I think where we are in this kind of late cycle extension is that we will see a return of inflation later this year, possibly earlier than that, but probably later this year. And when inflation starts to come through, we'll probably be starting to think about central banks going back to tightening. So it probably puts a window of opportunity here in terms of, you get this global synchronized rebound, you get inflation coming back, and then you get central banks going back to tightening, and then probably not this year, probably 2021. We don't want to try and get too clever. That'll probably put a lid on how far the mini cycle can go before central bank tightening puts a lid on that. The sort of counter argument to that would be that central banks realize that they kind of made a mistake in 2018 by tightening too much, and then therefore actually step back and just let it run a bit further and let this inflation kind of thing overshoot to the upside. So that would be the kind of ultra bull case for tips on at least the break-evens component. Moving on, US equity valuations. So this is quite an interesting chart. One that's I think is quite important for equities. One that's quite important to understand in general, but certainly one that's quite important right now. So we've got two lines there. The black line is the blended PE ratio. That's a mix of the trailing, so last 12 months PE, price to last 12 months earnings. Forward PE, so price to next 12 months earnings. And the PE10, price to the average of earnings over the last 10 years. So that has, since I posted that line's actually gone up and matched the that previous peak there. So it's basically one standard deviation expensive versus long-term average, or at least this period average. So in absolute terms, it's pretty accurate statement to say that US equity market is very expensive. Before I go into the red line, I will note that, you know, it got way more expensive in the dot-com bubble. And again, if that's your yardstick, maybe it's not the best yardstick, you know, just as the crisis was not the best yardstick. Do we ever return to that kind of bubble for the US equity market? Probably at some point, but whether we do right now is a bit of a guessing game. But anyway, you know, following on from that, actually, I included a similar chart to this in my weekly tweet storm, and I noted there that, you know, well, a little bit of a open question is whether going past that one standard deviation expensive versus long-term average, whether that is actually a barrier or a breakout, because, you know, back in the late 90s it was actually more of a breakout than a barrier. But moving on to the red line, this is a really important one. This is the equity risk premium. So I've inverted it because, you know, typically it's actually a positive thing. But anyway, the way that you calculate that is some form of earnings yield minus some sort of inflation, maybe, minus a real yield. So it's, I mean, at its purest form, it's the earnings yield, which is the inverse of the PE ratio. So 1 divided by the PE ratio minus some sort of risk-free rate. In this case, what I've done is I've used 1 divided by the PE10. So that actually gives you a kind of smoother, less noisy version of the earnings yield. Because if you use trailing PE, it'll give you all sorts of wacky results. Ultimately, when you're thinking about valuation indicators like these, they should be telling you that the market is expensive when, you know, historically when you've been at high levels or peaks or, you know, tops, and it should be telling you that the market is cheap when you're at a major market trough. If a valuation indicator doesn't do that, then cast it aside. So anyway, yes, so using the earnings yield based on the PE10 or cyclically adjusted PE minus the 10-year treasury yield, which is just a market observation, minus the 10-year rolling CAGR or compound annual growth rate of CPI. So again, a smoother version of inflation to give you a real yield. And basically when the equity risk premium is positive, which it is at the moment, you can't kind of tell on this chart, but basically the higher the equity risk premium, the more that you get rewarded for going into equities versus safe assets, i.e. bonds. And at the moment you're still getting rewarded, and so on an equity risk premium basis, US equities are still cheap. So it's telling you basically the opposite of what the, you know, absolute valuations, the PE ratio, is telling you. And you know, ideally, you know, to become, you know, high conviction bearish on US equities, you'd actually want both of those indicators to be telling you that the market is expensive. For now, you know, I'd actually say that if you focus on that red line, the black line, the absolute valuations hitting that one standard deviation expensive is not a barrier, and that you probably do see it go higher. I would say that bond yields are probably going to head up quite a bit this year. Certainly if you think that there's any validity to the first two charts, better growth and, you know, number 4, better inflation, that's going to push bond yields up. That'll squeeze the equity risk premium. So, you know, that is definitely something to be mindful of. And, you know, back in 2018, that's actually what we did see. We saw bond yields going up, and that squeezed the equity risk premium, pushed it into the expensive zone. And you know, I don't need to tell you what happened after that. Moving on to global equities. One thing I wanted to highlight here is these global equity breadth charts. So these are something that I track quite closely. It's something that I've put together over a bit of time, and it's tracking 70 countries, so the main index. So instead of, you've probably seen the market brief charts for the S&P 500. Market brief charts for the S&P 500 is tracking individual, breadth stats across individual companies, individual stocks. This chart is tracking it across 70 countries, so individual countries' actual main benchmark. So for the US, it would be the S&P 500, for the UK, FTSE 100, and so on and so forth. The good thing about using, this kind of technique to look across these 70 countries is that it helps you pick up on, quite broad-based trends across global markets. It can also be quite helpful because oftentimes, it's an early warning indicator. You'll see some sort of issue that's going to become, a globally important issue. You'll see it start to show up in, a handful of markets sort of on the fringes first, and then that'll sort of spread across the rest of the world. But also to the upside, when you see these kind of breakouts here, well, two things actually. Back in December last year, December 2018, got to get our years in check here. So back in December 2018, we saw quite a washout in market brief here. So this is just 52-week highs, new highs minus 52-week new lows. Saw quite a washout there. That's basically a significantly oversold signal there, and then again we saw this breakout here, this bread thrush basically, where you saw a broadening out of the global of strength across global equities, and that late last year actually I was tracking this and the other bread charts quite closely, gave a pretty clear signal, or pretty familiar signal actually, of a new cyclical bull market. And I want to really put emphasis on that new bull market statement. There is this kind of wrong understanding that we've been in just one big bull market since 2009. But to me, it's really been a series of bull markets, a series of small cyclical bull markets. And sure, if you sort of, squinted your eyes, maybe you'd see just one big long straight line, but anyone who actually lived through this period would know that, it wasn't that straightforward. You had this initial recovery period, then you had another bull market there driven, basically by QE among other things. Then you had a reset, and then another bull market, another reset, and another bull market. And actually back in 11-12, that was kind of a reset as well. We had the Eurozone crisis. 15-16 was emerging markets and commodity sectors into recession, and then 18-19 was the export manufacturing recession. So these kind of series of resets, series of recessions, one, it has meant that we've actually had a series of little bull markets. It's also meant that we've had a series of mini cycles. So it would be also quite wrong to say that this has been one big, long, the longest economic expansion, because you've actually had a whole bunch of recessions along the way, which have kind of, they haven't been full-blown recessions, for those who are using 2001, 2, or 2008 as their yardsticks. It hasn't been full-blown recession, but it has been, little recessions. And why that's important is because, pretty clearly we're now embarking on a new cyclical bull market for global equities. Certainly if you think about those two charts at the start, global economic rebound, that's the kind of fundamental backdrop that's going to help, the liquidity flood that's helped boost this, coming from fairly oversold and cheap levels too. So at a global level, if you look at the P ratios for global equities, it's actually just around fair value certainly if you look ex-US, it's a lot cheaper. So global equities, fairly bullish there. Certainly would not be looking to exit anytime soon. Maybe hedging on a tactical basis, but that's a matter for another discussion. Because actually, on that note, when I'm talking through all of these charts, this is kind of the more medium-term view. So, for context, I probably should have mentioned this at the start. Most of my clients are asset allocators, and even the more active ones, they tend to take 6 to 12 month view. A lot of them take a 1 to 3 year view on their active calls, and part of that's down to philosophy, part of it's down to just plain constraints on the speed that they can move, because sometimes they need to go through Commodities to actually do their decisions, and then implementing can take quite a while as well, especially for those that are running fund-to-fund structures. But anyway, the point is, this is more of a medium-term view. So again, that sort of 12 to 18 month kind of view here. So not a trading view for the next few weeks. Probably should have mentioned that at the start if you're just a day trader. But I guess even if you are more of a short-term trader, this is probably, well, as you can probably gather by now, it's can be useful for sort of setting that a bit of context for the wider trends at play. Commodities, this is a really key chart, and quite similar conclusions, but slightly different from the previous one. So commodities breadth, and again this is me taking a market breadth technique that we usually use in the stock market and applying it to commodities. This is looking at the I think it's about 22 components of the GSCI, which is the commodities index. As you'll see in here, that black line is the light energy index. So what does that mean? It's the version of the GSCI that has more kind of equal weighted allocation across the different commodities, so it's more diversified index. The normal GSCI commodities index has quite a significant exposure to energy. I think almost something like 70%, so it makes it very much a reflection of what oil's basically doing, But anyway, the breadth indicator here, and this is probably actually a breadth indicator that you might not have seen before. This is the proportion of commodities which are positive on a year-on-year basis. So the price is higher today than it was a year ago. As you can see there, it had this kind of washout moment back in 2019, and then it's hooked up quite significantly. So I think it's just under 80% of commodities are higher versus where they were a year ago. So that tells you that we're seeing quite broad-based strength across commodities. Similar to equities, when you see this kind of pattern where this indicator gets really washed out and then turns up, that's been a pretty reliable bottoming signal, or something that you see at the beginning of a new bull run. So we saw that in 1999 there, when we had that little bull market there, and then again just before that, pretty unprecedented amazing run really that commodities had there. And then again in 2009, a shorter one, and again in 15, 16 there after that big multi-year bear market and then subsequent crash. And also worth noting there is that little I guess you can call it symmetrical triangle. It's not quite a descending wedge there, but yeah, basically symmetrical triangle pattern there. We had a breakout to the upside, kind of helps frame the situation there. And you also had this kind of downtrend there, so it's not pictured in this, but I have it on other charts, but you can kind of see this, where my mouse cursor is going here, there's kind of a downtrend line there that it probably still does actually need to break. And then another level there is just that kind of horizontal line if you drew it across there. But so, there's a couple of tests that commodities still need to pass from a technical standpoint there, but already you've got this pretty interesting breadth signal there. And then, I never like to rely on any one indicator. I definitely make use of technicals, and this is kind of the technical picture that I've just walked you through. But if you bring in a couple of other factors, so positioning is still fairly light. That's kind of changed in the last few weeks. People have started to come around to the idea that commodities, maybe this is the time of the cycle where they're going to do well. And if you think about it stylistically or conceptually, commodities is kind of supposed to do well at the later part of the cycle. If you think about those first two charts, they are basically advocating for a late cycle extension. Commodities probably going to do well in that backdrop. Certainly if you get a global growth rebound, and especially concentrated in emerging markets, that's going to be quite bullish for, well, definitely a constructive backdrop. And then on my valuation indicators, as you might have gathered also from chart number 3, that growth assets versus defense assets, commodities are cheap on my indicators. I mean, there's a bit of nuance across commodities, and I can probably go into that another time, but at an aggregate asset class level, it's looking pretty good for them this year. FX volatility. So I could probably talk at length about the US dollar here, but I'll just basically say that my view is bearish US dollar. There's quite a list of reasons, and already starting to see confirmation on a few key fronts there. So, I was bearish US dollar through most of last year. If I go back there, I was bullish back when it was at the low point there, flipped bearish back about here where the mouse is. So it was a bit of a frustrating year. It was wrong, and that the US dollar went up, but not spectacularly wrong. And I think that basically seeing it rolling over now. But aside from the directional call, I think one call that, or certainly something that a lot of people have started to spend some time focusing on now, is how low FX volatility is. And I mean, even if you didn't look at that blue line there, which is the I've created my own FX volatility index based on FX option pricing. But even if you didn't look at that blue line and just looked at the black line there, you can see that it's been locked in this very tight range. Even though it did go up, it hardly went up at all, and it never broke out of that range there. So I'd imagine that 2019 was probably quite a frustrating year for both bulls and bears for the US dollar. But anyway, when you get these crunches in volatility, they don't tend to stick around for that long. Like if you go back and see that one back in, I think that was late 14, again 2007, and again in I think that's 97 there. You've had these instances where FX volatility got extremely low, and those happen just before either a breakout or an acceleration, basically before significant moves. And that goes back to the old market adage that low volatility is a good predictor of future higher volatility, and vice versa. And so, particularly for US dollar here, we've seen some quite substantial moves that have followed these kind of compressions in volatility. Certainly if you looked at those particular examples that I mentioned, in 97, after you saw that crunch there, you saw a surge in the US dollar. obviously there was a lot of things going on in the background there, Asian financial crisis, etc. Again, in so 2007, the US dollar had started to weaken there, but then it saw a big acceleration, big move subsequently. And again in 2015, you saw a surge in the US dollar after that crunch there. And then you've had the kind of more minor crunches there. So, before it rolled over at pace in the early 2000s, there was another kind of low point in volatility. So the point is, I would say bullish FX volatility, bullish on the prospect of a return of volatility for currency market volatility. Whether that is, and actually that would be agnostic of direction, as I mentioned there. So, while I'm sitting here telling you that I got a bearish case for the US dollar, that could be wrong, and it could surge to the upside. But it could, if I'm right, it would be a collapse to the downside. So it's definitely one to be quite mindful of, I think, and quite intently focused on early indications that the US dollar is going to make that move one way or the other. I mean, just as I've got my bearish indicators or my bearish setup there, I'm still quite intently focused on a couple of key technical indicators and levels that would kind of give me early warning that that case may be wrong. Probably some of those bearish indicators would start to turn anyway. But if I saw a US dollar, clear signs that it was going to strengthen instead, I'd be paying very significant attention to that, because US dollar has pretty profound implications across global economy, because it has an impact on global financial conditions, but also has direct implications for commodities, emerging markets. Obviously, if we saw a collapse in the US dollar, that would be a big boost for commodities. So, thinking about my views, which I've basically laid out here, there's a bit of internal consistency, which is, it's always a good thing to see. Last couple of charts here are kind of honing in on some sort of, smaller level things. These have been so far quite high level major asset classes. US value versus growth. This has been one that, the investment strategy graveyard is basically littered with failed calls for a turnaround in the performance of this one. So what makes me think that now is actually the time? Very good question, and the right question to ask. So one, just looking at price, very extended. So this is the price performance of value versus growth. It's the S&P 500 value index versus the S&P 500 growth index. So value, very poorly performing, very stretched to the downside on price performance. If you look at relative valuations, value is much cheaper than usual versus growth, and it's at an extreme. It's basically at its lowest point in 20 years, and valuation has the strongest signal when it's at the most extreme, e.g. now. But valuation alone can't, if you've got a long enough time frame and you don't mind riding through the volatility, you can rely on only valuation, but you tend to find that ideally you want to line up valuation with a few other things. So we are actually seeing that already starting to bounce, starting to turn there, and certainly I would be paying attention to price. But on the macro front, that's where I would be focusing my attention in terms of what's going to actually make this turn around. So if you look at the sector composition of value versus growth, the sectors that are kind of slightly overrepresented in value are things like commodities, financials, And so if you think about what benefits those sectors, financials tend to benefit from higher yields. They also benefit from better growth. The commodity sectors, so materials and energy, they benefit from higher commodities. I've just talked to you about why I think commodities are going to go higher. So if you have commodities picking up, bond yields picking up, growth picking up, that's going to help the sectors that are kind of overrepresented in value. Coming from a point of extremely cheap valuations and where prices are already starting to look like it's starting to turn, that could be the thing that finally does it. Now, we'll just note in passing, if you look at this chart here, where value really massively outperformed versus growth, so from 2000 to basically 2008, 2009 there, there's basically 10-year, decade-long period of outperformance of value versus growth. The initial phase of that happened by the market at a headline level going down, but value going down less than growth. So that is probably what you might call bad outperformance of value versus growth. So, in terms of how you'd actually do something with this, to actually benefit from that in absolute terms, you would have had to be running a long short position. So you would have had to be long value stocks, short growth stocks. The second period, though, is what you might call good outperformance, where value outperformed growth as the market was going up. And in that period, you could have just been, you could have just directed your equity absolute exposure to more value-y names instead, and just outperformed. So what would this period, if we did see this turn here, what would it be? Hard to say. Given that I've still got a medium-term bullish view, I think you'd at least have maybe a year or two of good outperformance, but certainly still mindful that it could sort of mean revert through the less friendly way. But I guess it's kind of like a consolation prize in a way. If you're holding something that's falling, but it hasn't fallen as much as the index, well, maybe absolute terms it's not so great, but relative terms, it's a small consolation prize. So that's the case there. Again, it's fraught with these sort of false dawns, and after that significant 10-year period there of outperformance, it tempted a lot of people to try and call the bottom there. But maybe here we're finally at that. And if we're running a 10-year cycle, we saw 10 years of outperformance, 10 years now of underperformance, maybe 10 years of outperformance. Maybe less, but maybe turning at least. Last one, China. Certainly last but not least. This chart here is showing you in the blue line China property prices year over year, and the black line, the Shanghai Composite, so China A shares, also year over year. Why have I mapped these two on the same chart? Well, basically it's hinting at this interesting dynamic that you see with domestic assets in China. Because you've still got those kind of capital controls, because you've still got this situation where capital is or certainly the marginal speculative investment dollar is basically trapped in China, you see this process of it chasing the next hot asset after the other. So, in the early tens, back in 2011, around there, it was chasing like the wealth management products, then it was chasing property, then it was chasing stocks, then it was chasing property again. Probably the most dramatic example of that was that big bubble or bull market in 2014-15. One reason that was so explosive was this sort of rotation effect out of property into stocks, because the property market rolled over there, and you know, not only was it fleeing the bad returns there, it was chasing the hot returns in the A shares. So now that we're seeing property prices rolling over again, and a couple of leading indicators that I'm looking at are pointing to follow through there. You get follow through there, that'll have the marginal speculative investment dollar in China thinking maybe we get out of property, and then at the same time China A shares looking a little bit better now. So maybe we see another repeat of that rotation. The trade deal certainly, or the trade truce is definitely helpful. It takes that headwind, that risk kind of off the table for China A shares. It's I think it's probably going to be quite a good catalyst there. China A shares still cheap, monetary policies easier in China, and if you get better global growth, that's going to be a combination that's going to be pretty good for China A shares. So it's one that I'm paying a lot of attention to. It's one I'm going to review and cover in the next weekly report. But this brings us to the final thoughts and key takeaways. So just a quick run through to summarize there. Expect a rebound in the global economy led by emerging markets. Defensive assets are extremely expensive, making them possibly sources of risk rather than hedges of risk. And actually, that's something that I didn't mention but wanted to mention, was that this chart of defensive and growth assets through price is kind of telling you where positioning is, or sentiment is. Defensive assets can only get that expensive if people are chasing them, if people are crowding into them. And so basically that tells you that, while sentiment has started to shift in recent weeks, if you look at positioning across fund managers, it has actually been quite defensive. So I think, people are basically going to be offside to this view that global growth picks up. And, again, defensive assets being expensive, potentially sources of risk rather than hedges of risk. Commodities and inflation expectations are set to do well, as the late cycle extension thesis will provide a supportive macro backdrop. Bearish US dollar, but bullish on the prospects of higher FX volatility. Stay bullish global equities, but wary of higher absolute valuations in the US. For now though, the equity risk premium is still cheap. So, there's no clear signs saying get out from a cyclical standpoint. I will admit that there are a couple of tactical indicators in recent weeks that have lit up that, raise the odds of a short-term sell-off or correction. But, unless something big and fundamental changed, that wouldn't be rattling, the rest of the kind of bullish medium-term story here. So final thoughts and bottom line. I might just read this out to you, and if I think of anything extra, I'll pop it in, but here we go. Last year was an interesting one in multi-asset strategy. For a while there, both bonds and equities did well. In fact, probably the only way to get it wrong last year was to be overweight cash. Looking forward, I think 2020 is going to be more binary. It's going to be either bonds do well or equities do well. And as you gather from the charts in this post, my view is that this will be a year that favours risk and growth assets and not defensive assets. Given some of the key market breadth developments late last year, the lay of the land in valuations, and the economic leading indicators, to me it seems rational to continue to favour risk assets over the medium term, particularly commodities and emerging markets, and remain underweight defensive assets. The tactical outlook, of course, will be a moving target, as I just kind of referred to, as geopolitics and just politics will no doubt drive bouts of volatility, and swings in sentiment will provide opportunities. Finally, as regular readers will know, I will be updating this blog post on a quarterly basis, and again at the end of the year, just like I did with my 2019 charts. So you can go and audit me and have a look at those 2019 charts. I'll put the link in the description. Other than that, be sure to follow and keep in touch. As I mentioned earlier, I'm going to be putting a series of 10 blog posts out over the next 10 weeks, which will go into each of these specific charts and just elaborate and provide a little bit more context there. Also, as you might have noticed, this is this post here is on LinkedIn. If you're on LinkedIn, definitely feel free to connect.